Welcome to Unfiltered Finance, and we are talking about Q4 earnings reports from the big banks that have come in this week. Joining us today, Nate Tucci. Thanks for joining us. I'm interested to hear your first immediate takeaways.
Yeah, well, my first takeaway is that I think we're seeing more of the same in terms of we're seeing a divergence between both layoffs and job reports and how that translates to earnings. And we're also starting to see a bigger divergence between top line expectations and bottom line expectations. And I think this is something that we're going to continue to see. For example, if you look at Wells Fargo's numbers, they took a hit. First, they took a hit because of other financials. So, financials are one of the most closely correlated sectors. When a bank misses earnings, you see all the other banks go down even before they report because the correlation is so strong. And so Wells Fargo was already down, and then they missed on earnings, and then they went down about 5%, which for the options nerds out there is outside even the expected move for earnings. But that was mostly on the gross number. The net number, the margin number on Wells Fargo was actually pretty solid. And so you're getting this kind of outsized reaction. And I think we're going to see more of that. It's just to oversimplify a little bit, but it actually is pretty simple. As you become more efficient as a business, you're going to look for opportunities to focus on your highest margin areas. You're going to implement AI where you can. And what often happens is that means okay, get rid of this team or get rid of this component or this service. And that does take away top line revenue because they weren't just negative. They were producing $100 million and losing $99 million, right? So when you cut them away, you do nothing negative to your net margin, but you lose $100 million on that earnings report. And so I think that's going to happen a lot more.
So when it comes to the markets overall, I mean, when expectations don't meet reality, the delta there, especially if it's larger, what does that mean for investors and the overall S&P 500?
Well, financials are, I think, one of the best gauges for the S&P 500. I might be a little bit different on this. I think a 50-50 would probably agree with my assessment on this. I'm not sure. I haven't taken any polls lately. But I tend to think that financials, because they are financials, are a really great gauge for the market as a whole. It's pretty difficult for the market to be very healthy without the financial instruments being healthy. It's pretty hard for the market to be really weak if the financial instruments are healthy. So the S&P is a financial instrument and financials are financials. So they tend to, I think, be a good gauge of one another. And if you just pull up a chart, I'll share it so that we can pop it up on the screen. If you look at 2025, when the market was healthy, financials are healthy. When the market was dipping, financials are dipping. And you can see the correlation between the S&P and XLF, which is the financial ETF, are incredibly closely correlated. Now, they have different peaks and valleys in terms of how much they move. So we're not talking about literally if the S&P is down 1%, it means financials are down 1%, but they correlate together. When the S&P is having its worst days, financials are having their worst days, and the opposite is true too. So for starters, I think XLF or financials is a great gauge of just where the market actually is. And especially in today's world, because what you can have is you can have a $5 trillion market cap stock like NVIDIA move the needle quite a bit, right? If it has a 5% plus day, it's going to pull everything else with it. And so in today's day and age, in the stock market, you can get some really false positives or false negatives because the Mag 7, the big dogs, can have such a big impact on the market. And so one of the first things I do is I actually go look at financials. I go look at XLF and say, is it participating in this? Or is this just because tech's going crazy today or tech's getting crushed today?
Well, and that was going to be my next question, right? Is there some talk about how, the big banks and this sector specifically overall may be the next Mag 7, that they may lift the market in the same way that the Mag 7 do? Is that something you think is going to happen, or do you disagree with that statement?
I probably disagree a little bit, not in function, because again, I do think financials will dictate where we go as an economy, as kind of across the board. When people are using the banks, when companies are using the banks, I 100% agree that's a direct correlation of if there's money out there, if that money is bullishly biased or if it's bearishly biased, all of that stuff I'm in lockstep with it. The financials, like I was saying a moment ago, kind of dictate and show you how healthy the market is, how much potential there is, all that kind of stuff. Where I think that's not necessarily going to ever represent itself in the way that Nvidia or Apple or Microsoft is that the biggest players in the world own Apple and Microsoft and Nvidia. So by definition, they are broken up across those assets. And even at BlackRock, which is just a beast like no other of trillions of dollars of assets, gets bigger and bigger and bigger, you can make the argument that it does control the market at a level higher than Tesla or Nvidia. But it's still going to do that through Tesla and Nvidia. And so I think the replacement idea is not real, even if the functional control idea is real, if that makes sense.
It does. It does make a lot of sense. No, I mean, and acting as a bellwether, maybe for the rest of earnings season, because we've now got really the beginning, the first chunk in.
Yep.
What do you think this says about the rest of earnings season?
Well, I think financials are going to be interesting one because they probably will tell us how actively people are using the financial system, how aggressive are they being on taking on debt, like all of these things that will typically translate to, the rest of the big companies that we care about. They'll probably be a great indication of small caps because small caps are typically relying more on debt, things like that. And we're seeing that already start to show up in numbers. Where I think, again, people are going to have to be very careful is if between now, let's say between January 30th, we're recording this video in January, between January 30th and into February and March, where the rest of the companies are reporting earnings, if the market starts to figure out that earnings misses aren't actually earnings misses, you're probably going to see very different reactions for the same kinds of earnings announcements. I think that's what, whether true, but the reaction to that might actually end up being very different for, deeper into earnings season as we see the market react.
Well, specific to finance, it was expected that we would see double-digit earnings across the board, and several of the banks didn't quite hit that mark. Do you think that the outlook for this sector moving into 2026 is maybe a little too optimistic based on this?
I don't think so. I think, again, they are self-diluting those numbers through trying to be more efficient. Now, obviously, I think that's mostly AI driven, but I also think that they knew interest rates are high. That can be, good on the investment side, but it can be bad on the debt side. And so let's be really efficient for the rate cut cycle so that as we are providing more debt, because I think they absolutely will, they're doing that at higher margins. So I think most of that is self-created dilution of top line. Is going to be a 26. Where that shows up in the earnings numbers might not be till Q4. So you might look back at 2026 and say, yeah, actually financials did underperform. But I highly doubt that you'll see that in the reality of the net numbers and kind of how they're positioning themselves for, let's say, the next 18 months, if that's how long we think the rate cut cycle kind of lasts, especially now that it's been paused and kicked down the road a bit.
So if I'm looking at my portfolio and I'm trying to figure out, okay, where do I want to invest? Do I want to stay in financials? Do I want to get out of it? Do I want to increase? What is the key takeaway here for investors?
Well, for investors, I think that the key answer here is that you can't be overloaded in your bias. You can't say, listen, Nate thinks financials are actually more positive than they look, which I do. I agree. Therefore, I'm all in on financials. You have to be very careful with the assumptions you make because even if they're right, doesn't mean the market is going to respect that they're right. So the way that I would do this is I would trust my bias that I am confident in financials. As a matter of fact, I just traded Wells Fargo, even after dipped 6%, but not in a hey, I'm ride or die on Wells Fargo. In a way that I risk define trades, whether that's a debit spread or an option structure or just a certain amount of shares that you're comfortable adding and cost averaging. However you want to do that, a risk defined outsized reward type of trade. If your bias is right, great. You had a greater outsized ROI than you could have, kind of previously to some of these misses. And if you're wrong, you're basically saying, cool, I still think the run is coming. I'm just going to better position myself at a lower price. So I think you have to kind of take it from a risk reward perspective and not a ride or die. The bias is right. I'm going to, that I think that's where you can get dangerous, because if the trend kind of continues to underperform, especially as what we've already seen in Q1, the market kind of starts to recover. It's pretty healthy underneath. We're seeing actually a lot of sector participation. Wells Fargo gets back up to pre-earnings, for January 13th or whatever that would have been, kind of gets to that level pre-earnings. And then Q2 misses. Well, now they're going to add in the Q1 miss cumulative to the Q2 miss, and you're going to see Wells Fargo dump 15%. And so you have to be very careful about not putting yourself in a position where if your bias is wrong by 6 months, you're in an unattainable trade that you can't hold on to. So I think that's really the risk.
What am I missing? What here? I mean, is there something I should be asking you that I'm not, that when it comes to overall Q4?
Well, for Q4, I mean, I think really the question is actually not so much financial. So I don't think it's going to be, listen, financials are going to come out. I think they're going to be a great, like we've talked about, a great bellwether for where the market is, how aggressive people are being with debt, all that kind of stuff is going to matter. And I think we kind of already know where much of that's going to land. We don't really know exactly how the market's going to react, but we kind of have a good idea. Couple percent risk tolerance, a pretty quick floor based on what we've seen just over the last week or so, where you can be negative, but only negative to a certain amount because, the net numbers are still pretty healthy. If you kill earnings, you're probably going to be capped on the upside too. And that's pretty typical for financials, as a sector anyway. The peaks and the valleys are pretty controlled. So I don't think we're missing anything, fundamental or critically important about financials, unless and until one company says, actually, these other guys, they got a little bit more efficient on AI. They dropped some bottom line, made up some net. They're positioned well. We instituted this new thing that no one's talked about yet, and our earnings are up. Happens this big other shoe to drop, and I don't think that's going to happen. But what I do think is going to be really interesting about Q4 is on the staples and the discretionary. And if you can look at what we've seen so far from the financials and get an idea of, how healthy they have been on their biggest consumers, their kind of mega cap borrowers relative to their small caps, you can probably get some hints about where that's going to end up. But I think until we see Amazon on the more discretionary side and Walmart on more of the staple side give us their numbers for Q4, we're not really going to know what Q4 looked like. Q4 is probably one of the weirdest quarters we've had in the last decade. We had everything from recession fears hit 75% to Black Friday shopping hit 5-year record highs to everything in between. And I think until you actually get those consumer spending numbers, because the bank numbers again, okay, let me say this way, the bank numbers are probably the best indication for the market, but we already knew that. We already know that the mega cap companies are probably going to make record profits again, like they have like 16 out of the last 18 quarters or whatever it's been. Because if Amazon can fire 50,000 people, it's not because they're not making sales, it's because they want more profits at the bottom line, right? We already know all that. That's what financials are going to be very highly correlated with, because all of the financials dollars are going to come in from their big borrowers and their debt holders and all of that. What we really don't know is if the consumer has caught up at all, or if the gap's just getting wider. And I think so. The financials for a bellwether on your S&P investment, good. Financials for a bellwether on, is the consumer gap getting way uglier than we even realize? It's going to be really hard to tell.
Yeah, well, we'll be looking forward to all of that, and of course, checking in here on Unfiltered Finance to see how everything plays out. Nate Tucci, thank you so much.